So recently, I had a number of people who are new to options trading. They reach out to me to ask, Davis, there are so many option strategies out there and I feel so overwhelmed. How do I know which strategy I should be using and how do I construct it? And more importantly, when should I put on each of these strategies? So I can definitely understand that it can be very overwhelming, especially if you're just starting out. But I'm going to share with you in this video that all you really need to understand are just two option strategies, and that's more than enough to actually lay the foundation for you to construct all the other option strategies. In fact, just from these two option strategies, you're able to construct most of the option strategies. And I'll share with you exactly also when to put on each of these strategies depending on your view. So what are these two strategies? Well, these two strategies, you probably have heard it before, or maybe you've even tried to place the trade before. So the very first type is what you call the credit spreads. So credit spreads, as the name suggests, you actually receive the credit upfront. That means the amount that you receive in the premium will be already credited to your account. And the other one is the debit spread. So the debit spread is just the opposite of the credit spread. So instead of actually receiving a credit to your account, you're actually being debited for the account. So you're actually paying for this spread upfront. So for the credit spreads, there are two types. The first one is what you call the put credit spread. So the put credit spread, otherwise also known as the bull put spread, is a bullish strategy, right? Neutral to bullish strategy. So that's why it's called the bull put spread. And then you also have the call credit spread. So the call credit spread is a bearish strategy. So this is where the name comes out as the bear call spread. So you have the bull put spread and you have the bear call spread. So that's for the credit spreads. Now for the debit spreads, similarly, you have two types as well. You have the put debit spread and you have the call debit spread. But this time for the put debit spread, this is actually bearish. That means you want the market to go down. So this is also known as the bear put spread. Now for the call debit spread, it's the opposite. So this is where it's also known as the bull call spread, where you want the market to go up. So when you understand just these few strategies, it will already set the context and the foundation for you to construct the other types of option strategies, at least the ones that you should be using as a beginner. So let's head on over to the option chain. So as you can see over here, this is the option chain, and I'm going to use SPY as an example over here. So let's start off with the put credit spread. So as you can see over here on the option chain, on the right hand side is where you have all your put options, and on the left hand side is where you have all your call options. So if you're talking about anything regarding the put options, you're looking on the right hand side of the column. So how we usually decide where we put our strike prices is by looking at the delta. Right, as you can see over here, this column here tells you the delta. So for very quick reference, if you want to construct a put credit spread, we generally go for the deltas that's usually further out of the money. So out of the money for the put side just means it's below where the current market price is. So as you can see over here, this price down here, let me just scroll it down a little bit further. This price down here tells you where the current market price is. As you can see over here, the current market price, at least as of this recording, is around 602.74. So that is why there is a line over here. So for the put side, anything that is below the current market price is considered out of the money. And on the call side, anything that is above the current price is considered out of the money. So generally for the put credit spread side, we want something that is slightly out of the money, because when we have it out of the money, at least we have some room of margin of error. That means to say if the market goes down, we can at least still be profitable. So let's just say, for example, let me choose somewhere around 587. So how do you decide where you're going to put the long put side? Well, it basically comes down to your risk. If your risk is roughly around $500, then you stretch it to about 5 points wide, because each dollar down here in interval of the strike price represents $100 in risk per contract. So if you have $1,000 in risk, then you just have to shift this to about 10 points wide. So based on this, we have a put credit spread where the risk is close to around $1,000. As long as you open it up to about 10 points wide, your risk will never exceed more than $1,000. So as you can see over here, if I scroll down to this P&L graph, you can see on the left hand side, right? Take a look at this number down here. You can see that it says 814. So 814 is the max loss at expiration. So as you can see, it does not go past $1,000. So how does it look like on the chart? So first of all, you want to take a look at this red line here. So this red line down here is basically where your current market price is. So if I was to go back to the chart and I remove all this drawing, basically it's somewhere below where this current market price is. Right, so let me just move this over down here so we can see it slightly more clearly. So if I was to draw a line down here, this denotes where the market price is. So your put credit spread usually is below where this line is. So let's say, for example, let me just draw two lines down here. This is where you have your put credit spread. So if we were to hold all this to expiration, just as an example, anything above here, you're going to be profitable. And anything below here, you're going to lose money. So as you can see down here, even though if the market goes down a little bit, as long as it doesn't go past this short put strike down here, you're going to be profitable at expiration. Now, what about the call credit spread, or rather the bear call spread? So we're going to go back to the option chain, and this time, instead of going to the put side, all right, let me just go to delete this existing positions. We will now go to the call side. So similarly, we also go out of the money. So again, same thing down here. Maybe I'm going to go for somewhere around 615. Then I'm going to open up the option chain so I can see more strike prices. And then for here, I am going to buy a further out of the money call strike. So down here, maybe I'm going to choose this time 620. So again, 5.1, that means to say your risk will not exceed $500. So if I was to go down to the P&L graph, you can see it looks like this. Similarly, this is where the current market price is. And if we take a look at the max loss, you can see the max loss is about 337, and we do not actually go past the $500 risk. So let's say if you want exactly at the $500 risk, so what you're going to do is just stretch this to about 2 points wide, right? Down here is 622, and we take a look at the risk down here. You can see it's about $486, right? As you can see on the left hand side. So we have not exceeded the $500 max risk. Let's say if that is the max risk that you want to set for the trade. So if we were to go over to the option chain, it's just pretty much the opposite. So again, same thing. This is where the market price is, and your call credit spread would be above down here. So over here, similarly, if we were to hold to expiration, anything below here would be in a profit, and anything above here would be in a loss. Now that we have covered both the credit spread side, let's head on over to the option chain to construct the debit spread side. So the debit spread side, how do you construct it? Also, it's very simple and very similar. So for the debit spread side, if you're looking at the put debit spread, we want to look at the right hand side down here. So for the put debit spread, we generally want to go for somewhere that is close to at the money. And the reason we want to do that is because when you go for too far out of the money, let's say somewhere below here, your win rate is going to drop significantly. So based on around this put debit spread around at the money, you should get somewhere close to about 50% depending on how you construct it. So if we were to go all the way down to the P&L graph, you will see that it looks something like this. As you can see over here, the risk reward is actually much better than the credit spread. So the credit spread is the opposite. You have a higher win rate, but the trade-off is that you have a worse risk to reward ratio. That means to say you're probably going to risk more than what you actually make on any given trade. The debit spread is the opposite. So as you can see over here, this is where the current market price is. And what is your max risk? So for this trade, you can see your max risk is 181 and your max profit is about 319. So it's pretty nice when it comes to the put debit spread. So if you were to go to the chart again, let me just go to the chart. Again, this is where the current market price is. So if you were to construct the one that is at the money, it will be something like this. So you have the two strikes down here, and you have the long put, and you have the short put down here. So anything that is below this whole structure down here at expiration, then this will be in a profit. And anything above here, so down here, would be in a loss. So this is for the put debit spread. Now, what about for the call debit spread? So for the call debit spread, let me just remove all these drawings again. Let me remove all this. So similarly, we also want to construct one that is somewhere around at the money. So similarly, I'm going to do this. I'm going to buy, right? I go to the ask, I click this, buy this put option, and I'm going to sell one, let's say, for example, 10 points out. So from here, if we were to go to the option chain, you can see this is how the call debit spread looks like. As you can see, this is where the current market price is as well. And you notice that the risk and reward ratio down here is not as good as the put debit spread, right? You take a look down here, it's about 5 to 1, here is about 479. And the reason is because there's this put skew on the SPY. So SPY has put skew, which is why you generally tend to have a better risk to reward on the put debit spread than the call debit spread. So if we were to go over to the option chain as well, similarly, same thing as well. Let us see the market prices here. So the call debit spread would be somewhere around here. Let's say we go one that is somewhere around at the money and then somewhere above down here. So similarly, at expiration, anything that's above this call debit spread, you will be in the positive, so you will be in a profit. And anything that is below the call debit spread, it's going to be in a loss at expiration. Okay, so now that you've already understood the two different type of option strategies, you have the credit spreads and then the debit spreads. Now this has already laid the foundation for us to construct all the other types of option strategies. So first of all, let's talk about the combination of both the credit spreads. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So again, we have your put credit spread down here. So you know this is bullish. We want the market to actually go up or not go too far down below our credit spreads for us to be profitable. Now, what if you combine this with the call credit spread? So as you can see down here, let's say your call credit spread is up here, then what this means is that you now have the iron condor. So the iron condor is pretty much just a combination of the two credit spreads. So where you really want the market to actually stay is in between these two strikes down here. This is where the profit zone of the iron condor is. And if I was to go over to the option chain as well to construct this, you can see how it looks like as well for the P&L graph. So for this, let me just very quickly head on over to the 20 delta. So 20 delta, maybe let's go to about 568. And then to the other side, same thing as well. If we go to about 20 delta, which is somewhere around here, 622, and then let's go for about 5 points wide as well, you get 627. So this is your iron condor. As you can see down here, iron condor is just the combination of two credit spreads. So when do you put this on? You put this on generally when you think the market is going to go sideways, because as you can see, we want the market to kind of stay somewhere inside a range. We don't want it to go too far out, because past this range, this is where we're going to get into a loss. So if you think the market is not going to go anywhere, pretty much neutral, you put on the iron condor. Now, there is a variation to this iron condor, which is what's called the jade iron condor. And if you're wondering what's the jade iron condor, well, it's the defined risk version of a jade lizard. So you may have heard this jade lizard before. So the jade lizard basically is a combination of, again, two credit types of strategies. So the jade lizard, right, is just very simply the combination of a short put with a call credit spread. But for the purpose of this video, I want to talk about the jade iron condor, which is just the defined risk version, because most people do not actually have the capital to put it on maybe the SPY, right? Because SPY is quite an expensive product. So we're going to go for the defined risk version, the jade iron condor. So the jade iron condor similarly is just two credit spreads. Now, the difference is the width of the credit spreads. So let's talk about the put credit spread side first. So if I was to go for 10 points wide now, so let me just go for 570 and 563, we have a 10-point wide spread down here. Now for the call credit spread side, now this is where we actually want a smaller width. We don't want to go for too wide. That means we do not want an equidistance in terms of the width with the put credit spread. So for the iron condor, you have both the same spread width. But for the jade iron condor, we want slightly different spread width. So for this, I'm going to go somewhere around 35 deltas. Usually is where you want to construct the call credit spread side of the jade iron condor. And I'm going to go maybe about 1 point or 2 points wide to see whether I can construct one with no risk to the upside. So as you can see over here, there's some risk to the upside. So that means I need to change this a little bit. So This is how the Jade Iron Condor should actually be like. As you can see over here, it looks similar to the Iron Condor, but the difference is that now there's no risk to the upside. That means to say if the market was to go all the way up here, you can still be profitable. So why would you want to put this on? Well, the reason you want to put this on is if you are somewhat neutral to bullish. So a lot of the times you will notice that the market may not go past a certain price. So for example, if the market stays somewhere in a range, let's say for example over here, if you had this call credit spread down here, you would be able to get at least additional credit compared to if you only just had the put credit spread side. So when you add this call credit spread side, it kind of adds a little bit more credit to your overall structure. That means to say possibly you could potentially have a higher profit if the market actually stays inside this zone. But if, for example, the market actually shoots up, right, it goes all the way past your credit spread side, you're still going to be profitable, right? There's no loss compared to if you put on the Iron Condor. So this is actually pretty good if you put on the index ETFs, because the index ETFs are what you call positive drift vehicle, which means to say over the long term, the market wants to go up. And if you were to put the Iron Condor, what you notice is that a lot of the time you could be tested on the call side, and that's where you can get into a loss. So if you want to play into the fact whereby this is a positive drift underlying, and you will tend to go up more often than not, but of course there'll be times where it goes sideways and maybe a little bit down, then this Jade Iron Condor could be a good way to capitalize on such a movement. So now that we have combined two types of credit strategies, we can have another type of combination, and that is the combination between the credit and the debit spread. So this is going to get a little bit more interesting. So I'm going to share with you how you can do that. So first off, this is where you want to have a view of the underlying. So if you are bearish on the underlying, then out of the strategies that you have seen just now of the credit and the debit spread, the one you want to go for is actually the put debit spread, because the put debit spread is going to give you the most bang for your buck in a sense, because your risk to reward is actually pretty good, as you can see over here. And if the market was to go down, you can actually kind of make a little bit more as the market goes down. So this is if you're the most bearish about it. But what if the market actually goes up? If the market actually goes up and it actually plays into the positive drift, then you're just going to keep losing this money, right? As you can see down here, every time you put on this debit spread, and if the market keeps going up, which it actually does for the underlying of SPY, then you're going to lose this most of the time. So in fact, if you purely put the put debit spread consistently, non-stop all the time, this is actually a losing trade. So how can you work around this? Well, this is where you can consider adding a put credit spread on top of this put debit spread. So if I was to go all the way down here, so maybe let's say we go somewhere around the 20 delta as well, and we were to go for maybe about a 10-point wide spread or so, right? So if we go for about a 10-point wide credit spread, you notice first off, this down here is going to be a debit. So we're going to be paying for this, as you can see over here. And this is not what we want, because if you notice, this kind of already looks like a Iron Condor. It's just that it's being shifted from this side down here. So that's not what we want. So instead, we want to construct one where there's no risk to the upside. So what do? We just simply reduce the size of this put debit spread. So if we reduce it by this amount, right? So right now it's about 1.5 points wide. Now we have a credit. As you can see, this is similar to the Jade Iron Condor, which you saw just now, but the Jade Iron Condor is slightly further out. So you're going to have a lower max profit, but it's going to be stretched out slightly further. So this line in black is where the Jade Iron Condor should be. And this one in green down here is where you have what you call the put condor. So for this put condor, as you can see, it's pretty defensive, whereby we actually want the market to go down in order for us to reach this max profit zone. So again, this is where you are bearish, but maybe not too bearish. So this is a semi-bearish construct. So what if you're slightly more bearish compared to this construct down here, but at the same time, you do not want risk to the upside? That means you want to play into the fact whereby the underlying has a positive drift. Then all you got to do, very simple, is to shift this whole debit spread further to where this current price is, this strike price down here. So if I was to remove this, and I was to shift this to the point whereby the put debit spread actually shares the same short strike as this. So what I'm going to do is I'm going to increase this to 2 contracts, and I'm going to add one more contract down here for the put debit spread, right? As you can see, put debit spread and the put credit spread, they're sharing the same strike. This is where you actually have what it's called the put broken wing butterfly. Can you see now? The put broken wing butterfly is basically a combination of a put credit spread and a put debit spread where they share the same short strike. So just from the combination of the put credit spread and the put debit spread, you can have 2 types of structures. So this is if you are somewhat more bearish, whereby you want more of a slight protection to the downside, whereby if the market really goes down, then at least you have a chance of actually getting more inside this tent. Now, as you can see over here, this tent looks pretty small, yeah, because this is where our risk is a little bit low as well. You notice the risk is somewhere around 461. So if you want to have a bigger tent, then this is where you might want to construct it with slightly bigger risk, given that your account can actually take it. So you definitely need to have a certain account size to be able to adjust this. So this is for the bearish side. As you can see, you start off with the put debit spread, and then you decide whether you want to add the put credit spread side. And then if you want to make it a little bit more bearish, then you just adjust the put debit spread closer to where the put credit spread side is. Now, what about if you're bullish? If you're bullish, same thing. You start off with the call debit spread side. So the call debit spread side, same thing, we construct for about 5 points wide. This is the most bullish construct out of the rest, because if the market goes up, you're going to make much more than if you were to put on a simple put credit spread because of the risk to reward. So over here, generally, you tend to have a better profit if the market was to go up. But again, we don't know if the market will go up, right? Because what if the market goes down? Then you're going to be losing what you place on this. So this is where you can actually have very similar construct as well as what we did with the put side. So on this side, what you're going to do is you just construct another one, which is the call credit spread. So the call credit spread, same thing. If we go to this side down here and we construct it with about, let's say, about to 635, right? Let's go 635. Then let us reduce the call debit spread side as well. Then this is where you can have a overall credit. So as you can see over here, this is the opposite of what you saw just now of the put condor. So this is what you call the call condor. So if you're afraid the market goes down, it crashes, guess what? You're not going to lose any money. So it only starts to lose money if you go past this point down here, which is the break even. So this is down here is where you have the call credit spread side down here. So when do you put this on? You put this on when you are bullish, but not too bullish. So semi-bullish on this. Now, again, same thing as well. If you were to shift this side a little bit closer to where this call credit spread is, this is where you get the call broken wing butterfly. So as you can see, everything is all linked to each other. So let me just remove all this as well, and you shift all this closer to where this strike price is. So we're going to have 2 strikes down here, and I'm going to have just 1 strike on the debit side. So let's take a look at our construct. So as you can see, this construct now looks like a call broken wing butterfly. Now it looks a little bit weird down here. I'm not sure why. Maybe because of the market is closed right now, but it should actually just be a triangle. It should actually be a tent like this. So from here, we have already constructed a few different option strategies based on just the credit spread and the debit spread. So one last thing I'm going to share with you, and that is if you are extremely bullish. So what do you do if you're extremely bullish? This is where you can put on what you call the super bull. So the super bull is a combination now of a put credit spread and a call debit spread. So previously we have done the combination of the put credit spread and the put debit spread, and then the call credit spread and the call debit spread. Now we're going to do a combination of a call debit spread, but this time we're going to finance this purchase. As you can see over here, it costs $118 for us to put on this call debit spread. We can actually finance it with a put credit spread. So if I was to go all the way down, let's say for example to 30 deltas, let me construct it with maybe a 10-point wide spread and see what we get. So we can construct it this way, and let us construct this call debit spread a little bit wider and see what we get. So as you can see over here, this is what you call the super bull. That means now you are actually very bullish on the underlying, that you're using the put credit spread to finance this debit spread down here. That is why you notice there is no risk down here. In fact, you get a little bit of a credit. So if the market was to actually go past below where the current market price is and maybe somewhere around here, then you're not actually going to lose money. You're just going to get the minimum credit. Where your loss really begins is past this point down here, which is where you constructed the put credit spread side. Now, similarly, if you are bearish, you can just put the opposite of this trade, and that's where you get this super bear. So the super bear trade basically is just a combination of your put debit spread, and then you finance it with a call credit spread. So as you can see, all you need to do is to just understand the two different types of strategies, the credit spreads and the debit spreads. And just by combining these two in different ways, you are able to come up with all the different strategies. So hopefully this has been helpful for you. And if it has, please give me a thumbs up on this video and also subscribe to my channel for more options trading videos like this. And I will see you in the next video.